Okay, good afternoon, ladies and gentlemen. Very warm welcome to this week's weekly market review. This is for the week of 6th of June. My name is Benjamin Do, and with me is Sunny, our senior technical analyst. We'll be going through a couple of topics today, preliminary on China, the economic indicators, as well as what's happening on the stock market. So the most important slide is obviously the disclaimer. SIAS, as you know, is a charity. We are a non-profit organization and we are not licensed MES. So before you take any kind of action in capital markets, please be a licensed financial professional. Now, a couple of, announcements. The next SIAS session is on 19th of July. This is a Wednesday, 7 p.m. Can use the QR code on the right-hand side to choke your seat. This is exclusive for members. And do give us a review, hopefully a 5-star review on Google, again, the QR code. And this is in case you are not currently a member and you want to sign up. This is going for $1 per month. Essentially, it's $12 per year. And that will allow you to get the discounted pricing for some of the paid workshops that we do, as well as access to our exclusive monthly SIAS sessions. Okay, so I'm going to start off by talking about China. So China in June, or in general, after the COVID was over, there are a lot of hopes, especially in the beginning of this year, that China's consumption as well as export engine will recover to post-COVID levels. In the beginning, that was true because a lot of pent-up demand, as well as revenge shopping, revenge traveling. A couple of high-frequency anecdotal information came out in the last few months. Last week on Thursday was the Dragon Boat Festival. So it was basically a 3-day public holiday, Thursday, Friday, and Saturday in China. The domestic tourism revenue, so we're talking about revenue, so in renminbi, was about 5% less than before COVID-19. So less than was about 5% less than in 2019. So that's for the dollar value or renminbi value. Then the number of domestic tourism trips was about 12.8% higher than 2019. So obviously, what this means is that people are taking more trips. The number of trips was higher, but they're spending less on a net basis. I guess people are basically watching the wallet. Now, the last holiday in China was the Labor Day holiday in May. Domestic tourism was only 0.7% higher than 2019, so essentially was flat. While the number of domestic tourism trips was about 19% higher than 2019. So the narrative is again consistent with public holiday in May. So more trips, but less spending. So as you can see, in May, the spending was about flat compared to prior to COVID. But in June, because of the Dragon Boat Festival last week, it was about 5% less. So it does paint the narrative that, at least for domestic tourism, it is kind of slowing down. It's fading. And we also do have another piece of anecdotal information that came out last few days, that the number of new cars, retail passenger vehicles sold in China was about 5% less in June on a year-on-year basis. So that was preliminary numbers. So it does paint the picture that at least the consumption part of it is kind of fading. Now, this is obviously an issue for China because the export engine is also not doing so well, simply because the GDP growth, globally speaking, is slowing down, and of course, you've got geopolitical tension with the US, especially the US. So if they don't have the export engine, humming along, and the domestic or onshore consumption part of it is also not humming along, this is an issue for China. And hence the policy coming out of the PBOC, People's Bank of China, which is the central bank, the previous guidance, the latest guidance was basically a lowering of the what you call the key lending rate. The commercial banks have also, I guess, in conjunction with the PBOC guidance, have reduced their lending rate. This is what you call the loan prime rate, essentially the mortgage rates. Yes. So the 1 year and 5 year loan prime rates reduced by a measly 10 basis points. So that's 0.1%. The average mortgage rate is already at record low, and furthermore, in some cities, the authorities have also allowed even lower mortgage rates for very selective class home buyers. This will be the first-time home buyers. All right. So as you can see, the 1 year is now at 3.55%, and the 5 year loan prime rate is now at 4.2%. Essentially quite low compared to strong ones. And yet, we are not seeing apartment blocks, apartments flying off the shelves. So this is again looking at issues. China is still looking at issues regarding inclusion of the real estate sector in China. Obviously, you can see China Evergrande and some of the other property developers are still not out of the woods. So the issue is going to be what is happening here is that since the PBOC has reduced the interest rates, all things being equal, that will of course lead to a weakening of the Chinese renminbi, the Chinese yuan. So the Chinese yuan continues to weaken. Again, there is a lack of catalyst both on the real economy side as well as the stock market side. Economic slowdown, and again, just to put this in perspective, economics in China is still worth about 5 to 5.5%. So this is the kind of GDP growth that other countries would kill for. But in China, this is considered not good. All right, so renminbi continues to weaken simply because the economic outlook for China is pretty cloudy, and also given the PBOC's lower interest rate guidance. So Goldman Sachs, Mizuho Bank, as well as UOB say that 7.20 level is a key level for the Chinese yuan, and the reference rate set by PBOC is actually 7.1795 plus minus 2%. Now they are using a system which is quite similar to what MS is doing. So there is a reference rate, and then there's a kind of a band, right, plus minus. So as you can see, this 7.2 is still within the plus minus 2%, which means that the PBOC is likely to tolerate for the weakening of renminbi. Now, obviously, that is good from export perspective, not good from inflation perspective, but hey, inflation in China is not as bad as elsewhere. So I think they are comfortable with that. Get a little bit further. So the latest reading as of today is that the Chinese yuan tried, or rather tested, the 7.2 level, but retreated, so it's somewhere south of that. But again, if you look at this chart here, the trend line is quite clear. Right? Okay. Now coming to China's stock market, the June rally is evaporating really fast. It went up to as much as about 11% since the beginning of June. And of course, now you look at this chart, this is normalized. Yeah. So compared to the beginning of June, now the Chinese stock market is only about 3.5% higher than the beginning of the month. At one point, it was at close to 11% higher than. So as you can see, rally is really going down the drain, especially in the last week or so. So according to Morgan Stanley, active long-only fund managers, that means traditional fund managers that cannot short, can hedge long-only. So we're talking about the unit trust funds, so and so forth, pension plans. They have remained net sellers in May as well as in June month to date. So in May, active long-only managers basically sold in a $15.3 billion worth of Chinese shares. In June month to date, and we're talking about 15th of June, so it is 1 week lag. 15th of June month to date, the net sellers net sales position to the tune of minus $1.9 billion. You also have got outstanding short positions, short sell position by hedge fund managers, and that actually increased by about 1/3, 32% in June month to date. So as you can see, the smart money, professional fund managers, as well as hedge fund managers, do have got a pretty negative view of where the Chinese market is going. And it's really because of the passive fund managers that we have got some positive inflows in June month to date, and also with some contribution for hedge fund managers, probably doing very selective tactical buys. Because as you can see, some particular names already below fair value, quite cheap. So these are just the buys. But the strategic allocation for most of the active fund managers is basically on China. All right. So this is where we are with China. Things are not doing so well, both in the real world as well as in terms of stock market. The authorities do not seem to be in any hurry to push out a huge stimulus package because they want to add more leverage, especially at local, municipal, state government side of things. Those guys are connected. So they are going to be doing some kind of tweaks, but obviously, stock market is not happy about it. All right, so going to turn the time over to Sunny.
Okay, so the keyword that the Ben shared just now is selective buy, tactical buy. I think so. We will look at not only which counter to buy. Of course, the first half of this year is all about maybe AI and tech, and of course the levels we'll look at later on the chart itself. But first thing first, we'll go through the economic calendar, look at which of the economic data will be coming out this week. So I think this week the focus will definitely be on the core PCE price index, which is the preferred gauge of inflation for the Fed. So before that, on 20 and 29, Fed chair will be having some speech that will also shed some light on what the Fed would be thinking about the two interest rate hike, two small hikes that will be coming out in the second half of this year. So do look out for those on the 28 and 29 June. And of course, on Friday, the PCE price index will give us a further insight into how inflation is coming down. Okay, that's on the US side. On the China side, this week, we have the manufacturing PMI as well. So we have a previous reading of 48.8, which is below 50. So that is a slowdown. But we have a forecast of about 51. So we are looking at if the manufacturing can sort of break even or even go above 50. So to show that the economy is actually expanding. So this is what we will be looking out for on the Asian side of the market. On the CME Fed Watch 2, which is predicting or the calculating the probabilities of the rate hike going forward, the next Fed rate meeting will be on 26th of July, and currently the probability stands at 1.92, where we will see a 25 basis point hike to bring the Fed rate to 5.5%. Now, for the first half of this year, we started the year with the optimism that we are going to see post-COVID recovery, and we are likely going to see a bull market, especially in the China side of things, where we expect the recovery to be pretty strong because China was the country that came out last from the COVID pandemic, I would say, or at least the COVID restriction. But as what Ben said earlier, a lot of a roadblock in between. We have the China economy not performing as well, and then the scale back. And of course, on the global economic side, we have the US bank crisis, and then we have the collapse of Credit Suisse. So the bull market that we are all waiting for has been put on hold for quite a long time, especially for the first 6 months of this year. So will the second half of this year be a more positive time for the markets to move up further to sort of really participate in the post-COVID recovery? And then we will also see the inflation rate has already peaked, and then we are most likely will see that interest rate starts to stagnate or stay at the peak of about 5.5 if the latest probability reading is true, and then how we will see the rate cut going to come towards the end of next year, or towards the end of this year, or even the early part of next year. Okay, so let's look at the charts now. The Dow Jones Index was down 219 points last Friday, or down 0.65%. You can see since the rate pause that we saw the previous week, where the Fed chair announced that we will be leaving the interest rate alone at 5.25%. But then, of course, he added in that announcement that we are likely to see two small hikes, which in quantitative terms, it means the 25 basis point hike in the second half of this year. So how is that going to play in? So after that announcement, we see that the pause, we see a big gain in the market, but then after that, we see a pullback. Now, the Dow Jones Index is now hovering around the 20-day moving average, which is the basis of the Bollinger Band around the 33,600, which last Friday, we closed the Dow Jones Index at around 33,700. So where is the Dow Jones Index likely to hit? Now, if you can see, this is the three blue arrows. These three blue arrows signifies that we have a triple top formation, and this level, 34,281, would likely be a strong resistance level to watch. Of course, you may say we have tested it around the middle of June. We have a breakout above. I would see this as a false breakout because you can see that the pullback is actually quite strong, and we are now at the 20-day moving average again in between the Bollinger Band. On the support side, if we connect the low of October and March, we have an uptrend line, which also had a bounce during the May period, as you can see when it was tested. So I believe this time round, if the pullback on the Dow Jones Index were to retest this uptrend line again, definitely we would see a bounce again. So going forward, I think the rally that we see so far since the low of October is likely to continue. But is it time to go in yet to participate in this rally? I would say we still have to wait, because if you look at the indicators, okay, the MACD indicator, the MACD line is starting to cross below the signal line as of last Friday. We have also seen that the MACD histogram actually peaked below the zero baseline. You can see some red dots over here, which means that the MACD histogram is going negative. So what this means is we are likely going to see a pullback on the Dow Jones Index in the near term. And that means that the rally is likely going to have a pullback, which is also healthy because the rally has been going on for quite some time. Any pullback is considered healthy at this point of time. Of course, to maintain the uptrend that we see so far, you still need to uphold the uptrend line in green that you see over here. On the RSI, we can also see that RSI has been trending lower since the middle of June. 15th of June, it has been trending downwards. The current reading is just slightly above the 50-point mark at 50.04. It is also lower than the 14 days RSI moving average of 58.28, which means that momentum is actually weakening and likely to pull, the index is likely to pull back further. If we breach below the 50-point neutral mark on the RSI, that means we go below 50, then definitely the downwards momentum or the weakening of momentum will accelerate further, and hence it will ignite a further pullback. So where am I thinking the Dow Jones Index would likely use the support? Definitely the green line the green uptrend line would be the first level of support. If that fails, you can see that the 30th May or the 25th May level around the 32,500 would likely be a greater support level to watch out for the Dow Jones Index in order to sustain the rally that we see so far in the past 6 months. This level has also found confluence with the low bound of the Bollinger Band at 32,519 points. So this will be a point where a lot of traders will be looking out for to get back in, to jump back on the rally bandwagon. Okay, so next let's move to the S&P 500. S&P 500 is also overly extended, I believe, at this point of time. However, the key difference is you can see that the Dow Jones Index, we have a key resistance level, a triple top formation that was touched, but then it was a false breakout and we had a pullback. However, for the S&P 500 index, we also have something like a triple top formation. However, the breakout of this triple top formation was pretty convincing, and then now we are above that with last Friday closing at 4,348 points, which it was just down 33 points last Friday, or 0.77%. So where is the S&P likely going to go into the second half of this year? Definitely, I see a pullback coming. So where is the next support level? I will look at this resistance level. This triple top might become a resistance turn support level for the S&P 500 index. We are also now, the closing of last Friday is also slightly above the 20 days moving average. That's why I'm saying that index is a bit elevated now. Hence, I believe if a pullback below the 20 days moving average towards the triple top formation that we see here, 4,195 would be a good time to get back into the S&P 500 index to participate in the rally again. Of course, you can see just below this triple top, you also have a double top in December of last year that will provide another layer of support for the S&P 500 index at around the level of 4,114 points, which also coincides with the lower bound of the Bollinger Band right now at 4,106 points. So where I would get in on the S&P 500 would likely be between the 4,195 and the 4,114 level. Looking at the indicators, the MACD has been weakening for the past 5 trading days at least. For last week, you can see that the MACD line is converging towards the signal line, and a crossover is likely going to happen either today, tonight, or tomorrow when the US opens. So this would signify the start of a pullback, I believe, on the S&P 500 index if the crossover happens. And if you accelerate towards the zero baseline and cross below that, the pullback might even be stronger. Hence, it will likely see, it may even go to the uptrend line that you see over here, connecting the low of October last year, as well as the March of this year. On the RSI index, we have peaked on the 15th of June. The reading was 76.36 during then. And now we have come back down to the 59.59 level. The 14 days moving average of the RSI is 67.52. So we are in a downtrend now. So both the MACD indicator and RSI are signaling weakness on the S&P 500 index. So even if I want to get back into the rally that we see for the past 6 months, I will want a significant pullback at least to the 4195 level before I start getting back in on the S&P 500 index. Okay, so next let's move to the Nasdaq Composite Index. So this is the Nasdaq Composite Index led by the AI rally. For most of the past few months, we closed last Friday at 13,492 points, which dropped about 1.01% or 138 points last Friday. So where is it likely going to head? As you can see over here, we sort of have a rally or a price channel, uptrend price channel since the beginning of this year. So I believe this AI rally or tech rally do likely have more legs to run. So, but then whether it's time to go in or not, we have to analyze deeper into the chart of the Nasdaq Composite Index. So the price channel here, I'm going to sort of highlight this line. Okay, these two green lines. Okay, this is the price channel that we are looking at. Now we have risen above that price channel, which means prices might be a little bit elevated. It is also above the 20 days moving average. Hence, if you want to go long, this might not be the best time to go in. I will wait for the pullback to at least go below the 20 days moving average. As you can see over here, quite a couple of times this year, if you see that somewhere during the March period where it touched the lower bound of the Bollinger Band, then the rally starts to come back in again. So similarly, for the April period, you can see once it crossed below the 20 days moving average towards the low bound of the Bollinger Band, the rally comes back again. So this time around, I'm not expecting any surprises. I would need the Nasdaq Composite Index to cross below the 20 days moving average and come back down to test the lower bound of the Bollinger Band at 12,600 before I consider getting back into the Nasdaq Composite Index again. Now, around this level, we also have a double top formation for this year on the Nasdaq Composite Index in the first half, and that's around the 12,269 points level, which would provide further support for the Nasdaq Composite Index. So MACD indicator, you can see the crossover has already happened in the last 2 trading days. So we have a negative MACD reading right now. The crossover would signify that we are now going into a reversal of the uptrend that we see. So a pullback is likely going to happen or has already been confirmed by the MACD indicator. So first level to watch out for, lower bound of Bollinger Band, 12,600. The RSI reading, we have peaked around 15th of June also at the level of 78.08. Now the reading is 61.21, and the 14 days RSI moving average is about 70.49. So we are in a downtrend now. We are having a pullback now. So the pullback is likely going to drag on a bit longer because you can see that RSI has still 10 points away from the 50 days neutral mark of the RSI indicator. Hence, the slide would likely be quite steep, and hence do be careful if you are thinking of getting back into the tech rally or the AI rally. So wait for a pullback of the Nasdaq Composite Index, at least to the lower bound of Bollinger Band, 12,600, before you consider any actions to take or to get back into the rally bandwagon. Next, let's move to the STI index. So STI index is we are just down about 1% since the beginning of the year. You can see we have a downtrend line connecting the high in January and April as well. And of course, this downtrend line was tested again in June, around the 16th of June period. And then it was rejected again, and then prices started to come back down again for the past 1.5 weeks, I would say 7 to 8 trading days. So on this side, on the support side, we definitely have an uptrend line also connecting the low of October and March this year, which was tested during the May period of this year, and it also created that bounce. Now we are going into a squeeze of a converging kind of triangle formation, and this means that market is at a sort of a turning point, a midpoint, where we do not know whether the STI index will pivot upwards or downwards. But if you are looking at the indicators now, the MACD indicator is definitely showing that the momentum is actually weakening because of the drop in the MACD histogram in the background you can see over here. And of course, if a crossover of the MACD line below the signal line, and then both lines are going to trend below the zero baseline, then definitely the pullback will likely be stronger. And hence, the first level of support I'll be looking at will definitely be the lower bound of the Bollinger Band, 3,138, before I get back into the STI. Of course, the next level of support may actually be the year-to-date low, which happened in March this year, around the 14th of March period, and that's 3,128 points. On the RSI indicator, the latest reading is 48.95. The 14 days moving average of the RSI is 49.48. So both are pretty close, but then both are also below the 50-point neutral mark in the RSI indicator. Hence, I would say that it's pretty neutral to slightly weak momentum for the Straits Times Index now. Another reason could be a lack of catalyst going forward. Hence, Straits Times Index is likely going to consolidate further into this converging triangle before we see some kind of signal or a break up or break down. And then after we go into a critical support resistance point to see that the activity pick up again, volume pick up again, and then hence it will be a good time to sort of gauge where the trend is going further for the STI Index. So for now, it's pretty neutral to slight negative for the STI Index. Lastly, I'll cover the Hang Seng Index, which pretty much sums up the narration of the first half of this year. Okay, we are expecting a COVID recovery at the beginning of this year, but then of course everything goes downhill on the Chinese side. Of course, we have seen quite a couple of times this level over here, the low in March, which is around the 18,800 level, is actually a good support level to get back into the Hang Seng Index. Okay, why? Because we have tested this once in March, and of course the second time was somewhere around in the end of May or early part of June. We broke down this level and we had a bounce back up pretty strongly. Of course, the stimulus that we are trying to see, or the investors are trying to get from the regulators in China, are not that strong yet. Hence, you can see the disappointment was actually pretty true with a gap down last week on the Hang Seng Index. So I will still maintain that the support level for the Hang Seng Index is still pretty between the zone of 18,800 and 18,200, which is the year-to-date low. So that is the point which I will get back into the Hang Seng Index again to accumulate further or to add on to my position earlier for the Hang Seng Index. So the MACD indicator, as you can see, has started to turn negative. So do look out for the MACD indicator. If it goes down too far, that means the momentum on the downside is pretty strong. However, the RSI, as you can see, is already at the 40-point mark, which is 10 points below the 50-point neutral mark, as well as the 14-day moving average. Once it hits the 30-point level that we see over here, somewhere in the 1st of June, you can see the RSI here, the reading was 28, and then after that, we have a rally upward. So that is the point that I'm looking at to get back into the Hang Seng Index for the RSI to hit the 30-point oversold signal. And then that will probably be around the year-to-date low in 31st of May at 18,200, with a further support from the lower bound of the Bollinger Band at 17,924 points. So how are you riding the market, Ben?
Hi. Yeah. So looks like we're going to be seeing some kind of, I guess, reversal. So interestingly, the bond traders have started taking Jerome Powell more seriously. So I guess the bond prices have already started moving. They are no longer pricing in a slam down with an interest rate drop later this year. So I think they're really buying into the belief that there's possibly going to be 2 more rate hikes, or at least the same level for another term, which not quite sure what it means for the economy. Like, does that mean they think there's no recession, or they think that there's going to be a small recession, or we're going to have a recession, but screw it, we're going to have high interest rates anyway? I'm not quite sure.
Yeah, so my opinion is I think it will be a slight recession, a small recession, and then after that, the recovery will come back. So I believe the bond traders are taking Jerome Powell more seriously because of the testimonial or testifying in Congress last week, and then he was pretty adamant that the 2 small rate hike will happen in the second half of this year. But of course, this week, on the middle of this week, Wednesday and Thursday, Jerome Powell will speak again, so that will provide further insight and provide volatility to the market as well. So we'll look out for the speeches from the Fed chair to help us guide us through the markets and see how well is this. But for me, as a technical person, as a statistical person, I would believe that we should constantly look at the inflation number, whether it's the core PCE index numbers or even the core inflation numbers, to see what is the trend of the inflation coming down. Because once the inflation comes down to the Fed mandate of 2%, then the tune on the Fed chair or even the Fed policymakers will start to change, and then we want to be one step ahead of them.
Sure, but reading the tea leaves is an art, not a science. One last item. So the newsfeed just came in from Bloomberg. So the PBOC, the People's Bank of China, has changed the renminbi US dollar fixing. So now the reference rate is 7.2056 Just now when I was talking about it, the reference rate was fixed at 7.1795. So it does look like the PBOC is letting the renminbi, I guess, depreciate a little bit more. But I guess that will be to support the export market and to provide more clarity on the FX moves.
Yes, any kind of stimulus on the China side is very welcomed by the market as the second largest economy. Like you said, the GDP in China is what the other countries would queue for. So where are we looking for growth right now other than China?
I don't know, maybe in Indonesia or Japan, since you and I spent tons of money last week.
I hope we spend enough to boost the GDP by 1% on their side.
I'm not sure. All right. So thank you for that, Sunny. And thank you all for tuning in this week. So we're signing off from SIAS. See you again next week.